Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. This week, we talk about the rising global debt and its implications for investors. At $296 trillion US, equivalent to 3.5 times the global GDP, global debt stands tall and occupies the mind space of investors. Whilst the global debt has increased sharply over the past couple of decades, it is important to take a note of some interesting trends over that time. As per the data from the Institute of International Finance, over the 10 years in the run-up to the global financial crisis of 2008-2009, global debt stock more than doubled. And as a percentage of global GDP, global debt expanded a whopping 63 percentage points. However, global leverage slowed over the 10-year period that followed the global financial crisis. Between 2009 and 2018, global debt stock rose just 42%, and as a share of GDP, increased only 29 percentage points. This was a result of various sectors of the global economy increasing their leverage only slowly, while some sectors even deleveraged. Yet, global debt came back into investor focus during the recent months following a 13% increase during 2020. During just that year, global debt as a share of GDP rose an alarming 37 percentage points. Focusing on the more recent episode of the sharp rise in debt, the change in the stock of debt can be attributed largely to the increased government borrowing to fund their COVID-19 pandemic stimulus programs. Whilst the other sectors of the global economy, namely households, financial corporates, and non-financial corporates, increase their leverage too, the rise in public sector debt overshadowed rises elsewhere. Indeed, during 2020, the general government debt as a share of GDP hit its highest level since the Second World War. Of course, during 2020, the sharp fall in global output has further contributed to the rise in global debt as a share of GDP. However, as the post-pandemic rebound took hold, the situation improved. After reaching an all-time high in Q2 2021, global debt declined slightly to $296 trillion in Q3. Global debt to GDP ratios continued to decline, helped by stronger economic activity and higher inflation. However, most of this improvement came from the developed markets. In contrast to developed markets, emerging market debt hit a fresh all-time high of $92.5 trillion in Q3 of 2021. Whilst rising and elevated levels of debt is a concern, we think investors need to consider nuances before drawing implications for their investment portfolios. Leverage in the household and financial sectors is well contained, making them less of a concern for countries in which these sectors play a major role. For example, in the US, household sector debt as a share of GDP is much lower now than in the run-up to the global financial crisis of 2008-2009. Key point to highlight here is that the numbers often cited in research point to the gross debt. If you adjust for cash on balance sheets, the net debt is lower. Financial sector leverage is well contained now as banks have been deleveraging in the post-global financial crisis era. Non-financial corporate sector leverage has increased in gross terms, but when adjusted for cash on the balance sheets, net debt doesn't look alarmingly high at least. This is especially the case in the US. Debt to GDP ratios rise when GDP falls, and this has happened during 2020. By the same logic, debt relative to GDP should fall from high levels as GDP recovery takes hold. For a more intellectual discussion, it is worth considering if debt as a share of GDP is a right measure. After all, debt is a stock and GDP is a flow. So is debt to GDP ratio a good indicator? Perhaps debt service to GDP is a better indicator. Here, thanks to lower interest rates, debt service has been well covered. Of course, should interest rates start to move higher, debt service burden will increase. Over the long term, higher debt along with aging demographics will likely bring down the growth rates. Taxes might need to go up to improve debt service. Higher debt levels now mean lower propensity to raise debt to fund future growth. This is very much in line with our thesis that over the longer term, investors should expect lower returns. Thank you for listening. In case you like this podcast, please do share it with a friend or a colleague. For more information on what was discussed on this podcast and what all this means to your investments, please reach out to your contact at ADCB. You can also find a lot of investment related content on our website at www.adcbam.com. Thank you once again, and this is Kishore Muktinutalapati signing off.